Welcome to Daily Mortgage Rates Live with the Mortgage Calculator. We're going to go through some live rates here today like we do every day. And then we're going to go into a deep dive into a different topic like we do every day. And today's topic is going to be conventional Fannie Mae. We're taking it back to the basics. So we'll get started here in just a few minutes. Just let us go live on all the different platforms. We are streaming on YouTube, Facebook, Instagram, and LinkedIn. So give us a second to just get live on all the different platforms. In the meantime, feel free to drop a comment there in the chat. And we will get started shortly. Hope everybody is having a great week so far. Thank you to everybody tuning in. I see some people were already dropping comments. Looks like Nicole just dropped a comment. Mortgage Wizard, not sure who you are, but that's a cool name. I like Mortgage Wizard. Good morning. Good morning to everybody. We're just waiting a couple minutes here to go live on all the different platforms, so just hang tight with us. Then we're going to get into some live pricing. Then we're going to do a little deep dive topic here. But thank you everybody for tuning in nice and early. We will get started in just a moment. All right, it looks like we are live on all the different platforms. See more people tuning in, commenting. Adam, Melvin, thank you everybody. We'll go ahead and pull the chat off the screen now so we can get started. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and we do this show every weekday to go through the actual live mortgage rates for some different programs, and then we do a deep dive into a different topic every day. Now, today's topic, we're going to take it all the way back to the very basics, which is going to be conventional Fannie Mae loans. So we do pricing for conventional loans every day here on the show. We're going to do that still as well, have Nick do the pricing for that. But later during our deep dive, Jose is going to go into some different options or flavors, I guess you could say, of conventional loans and bring some of those differences to light. So with that being said, Nick, let's go ahead and pull up our pricing tool and go over what the actual rates are looking like this morning. So you can go ahead and take it over, Nick.
All right, let me switch my screen and we'll check it out. So, as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR with all the fees for today. It is July 18th, just after 11 a.m. Eastern, so all our basic programs are live. If you'd like a full breakdown, a full loan estimate of all the itemized fees that go into the APR, please get with one of our team members. We have over 300 licensed loan officers, and we're licensed in 24 states for primary and secondary homes. And we can do our business purpose DSCR loans that we love to do in 44 different states. So if you'd like a full breakdown, please get with one of our members. They'd be happy to provide it. For today, we're going to check out the general rates for our general scenario. As we do every morning, we'll set a loan amount of $400,000. We'll set a LTV of 80% loan to value, 20% down payment for all of our demos. We will set the desired price to $99. That means we will ask the computer to find the best rate at one discount point in cost, which is our typical request. Then we're going to check out our different programs. We're going to compare conforming conventional, which is also going to be Jose's deep dive topic later, to FHA, and then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs where we can use alternative income. We also have VA and USDA. Remember, VA is only for our eligible vets and active service members. If you do happen to be eligible, let us know. We'd be happy to quote it, no problem. And same with USDA. That's only for properties in a USDA eligible area. So if you do happen to be shopping there, let us know. We can quote it up. But since not everybody's doing both of these programs, we don't do that live. So we'll start today with conforming conventional. We'll do a purchase, 30-year fix for all our demos, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO of 760 and an estimated debt-to-income ratio of 40%. So with these basic settings, as we do every morning, let's check out the conventional rates. Looks like about the same as yesterday, 6.99 rate, 0.875 discount points and costs, and a final APR of 7.153. So remember, the APR allows us to compare across the different programs, all of the costs included. So please key in on this APR here as we compare the different options. So if our customer has any problems qualifying for a conventional Fannie Mae or Freddie Mac loan, typically the next option, if we go back to our pricer, set up the same scenario, is an FHA program. So FHA allows a little more leniency on credit type of issues, as well as a much higher debt to income ratio. However, for the demo, we will keep everything exactly the same so we can compare apples to apples. So with everything the same, let's go ahead and check out the FHA rates to compare. So best option here at the top, 6.125 rate for 0.625 discount points. And that puts our final APR at 6.705. So in this case, if our customer qualifies for both conventional and FHA is actually a touch cheaper here, including all of the fees and costs, including the mortgage insurance, the upfront and yearly mortgage insurance there. So definitely recommend our customers qualify for both, as I have been for the last couple months. Check out both options. And our customers that only qualify for FHA, you're in for a treat, as these recent changes to the program are making it very attractive. So this is our option for FHA. Now, if a customer has trouble qualifying for either FHA or conventional, many other banks or lenders don't have other options, but that's where we love to come in with our expanded guidelines, also known as non-QM. So many other banks or lenders don't have any of these programs, and we have over 5,000 different variations using alternative income. So everything else stays exactly the same, but now we get to choose which income method we're going to use. So typically we'll choose something different than full doc. Full doc's what's required for FHA, and conventional is 2 years of tax returns, what most people are used to. So we'll typically try one of the other options here, such as asset-related programs, business bank statement programs, our investor programs are for investment properties. We'll talk about that in a minute. Our most popular program by far is the personal bank statement 12-month program. So that's what we're going to use for our demo. And we also have RSU stated, VOE, 1099, P&L, and the CDFI, no ratio, no income one. But for the demo here today, we will use the 12-month personal bank statement. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they use their full doc 2-year tax returns, have different write-offs and may not qualify at all, or may not qualify for as much income as they really want, just for those issues. So in this case, instead of 2 years of tax returns, we're simply going to use their last 12 bank statements in order to determine a debt-to-income ratio of 40% in this case, using no tax returns at all and just their last 12 bank statements, the cash in their bank. So most of our self-employed borrowers qualify for double, triple, quadruple the income using this method, and therefore can qualify where they wouldn't qualify before. So these programs are amazing to solve those problems. Obviously, the rates are a touch higher, but let's check out the non-QM options. Boom, good option popped up again, 7.25 rate, 2.375 discount points and cost, a little costly there, but a final APR of 7.362. So this option, very comparable to conventional. Remember, conventional was 7.15, I believe, when we just pulled it up a second ago. So almost exactly the same using alternative income. And as we scroll down, there's tons of different options here to use bank statement income. Some of these programs may allow things like credit events like foreclosures and bankruptcies. So a lot of different ways we can not only use alternative income, but we can also get around other challenges that would cause qualification issues for any of our other programs. Now, before we pass it off to Jose, we always want to do our live rates for investment properties. So we love to work with investors, whether they're first-time investors or seasoned investors. We have some great options. Let's set up the same exact scenario, 80% loan to value, 20% down payment, and we'll compare our two investment options. We have conventional investment property options and our non-QM expanded guidelines options. Remember, the government programs, FHA, VA, and USDA, are not eligible for investments. So we'll simply compare these two. So with this demo, everything else will stay exactly the same as we've had. The only thing we've edited here is the occupancy to investment. So let's check out what adjustments the conventional programs have for investments today. Best option at the top, 7.125 rate, 3.75 discount points and costs, and that's a final APR of 7.383. So a great option there for our investment properties. However, most investors like to save cost discount points. So most investors ask for a little bit higher rate in order to reduce this discount point here, this 3.75, which is $15,000 here in our example. Our investors would rather deploy elsewhere. So unfortunately, with conventional, even if we go up in rate, there's really not very many options to reduce the points. So that's where we love to present our non-QM options. So for the final demo today, we'll set up the same scenario as before. And this time we'll do our expanded guidelines, also known as non-QM, for our investment property. So first thing we have to set up, as usual, our income option, and the most popular option for investments, and our most popular loan by far here at the Mortgage Calculator, is our DSCR loan. And that's because it actually doesn't require any income or employment from our borrower. We simply use the estimated rental income from the property we're purchasing in this demo to determine a DSCR. Stands for debt service coverage ratio. So if the estimated rents cover the PITIA of the mortgage, aka the property cash flows on a monthly basis, that is a ratio of 1.00 higher. The rents exceed the expenses on a monthly basis. We even have options for ratios under 1.00 where the rents don't quite cover the monthly expenses there. So tons of different options. For our demo, we always do 1.5 just so we can see all the different options pop up. And the final thing we have to select is a prepayment penalty. We always do 3 years on the demo. There are options for 0 that will limit the amount of loan programs and cost much more. And there are 5-year options as well. Not all loan programs allow 5 years. When they do, it does save us a little bit of money. So 3 years is the most common. That's what we always use for the demo. So let's check out our DSCR options this morning. So good option here at the top, 7.875 rate for 0.975 discount points and costs. Final APR of 7.941. So we've solved our problem for our investor. We went from $15,000 cash out of pocket needed to now just $3,900 in this example. So most investors, when they see this, it's a little bit higher rate, but they are able to purchase another property perhaps or deploy that money elsewhere. So I'd say about 90 to 95% of people purchasing investment properties, when they're presented with a DSCR option and a conventional option, even though DSCR does have a little bit more cost, a little bit higher rate, we'll typically choose the DSCR for the flexibility. So not only can we obviously reduce the discount points here, but we also have tons of other options as we scroll down. Some of these may allow, again, bankruptcies and foreclosures, and some of these may allow short-term rental income, which is very popular these days. So tons of different options. Please get with our team. They'll find the best one for your scenario. Now, let me go ahead and switch my screen again, and we'll get ready to go over our topic for today, which is going to be on conventional Fannie Mae loans. So whenever we select conforming conventional there on our demo, we are looking at the 2 conventional options. There are Fannie Mae options, which is one of the GSEs, government-sponsored entities that operates these programs. The other one is Freddie Mac, which we'll go over tomorrow. So 2 different options for loan programs with slightly different variations and flavors. So what we're going to go through today, obviously on our live demo, we just do one simple scenario, very cut and dry, 80 LTV, 20% down payment, pretty standard credit score. So today we're going to have Jose go into some more detailed examples of some specialty kind of tips and tricks and just kind of variations that come with the Fannie Mae program. So within Fannie Mae, as within Freddie Mac, which we'll go over tomorrow, there are various sub-programs, right, for first-time home buyers, people under area median income, people in certain census tracts. So both of these programs have some cool specialties. And then once we kind of dig in there, there's obviously variations within those specialties. They're very similar in setup, both of these GSEs and the programs they have. Very similar in name, right? Home Ready versus Home Possible is an example of one of their specialty program names. So a lot of the people on our team, make sure you know which one you're talking about. They do vary a little bit, but they're very similar as well. So today we're going to be talking about the Fannie Mae variations, and tomorrow we'll go over the Freddie Mac variations. So if you're ready there, Jose, let's go ahead and talk about some of these different options and go through an example.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. Obviously, we have a broad topic here, Fannie Mae loans, but we are breaking it down here for you so that you can see some different twists that can actually show you the power of automated underwriting and streamlining of the whole process, right? Um, you know, it's easy for the 20% down borrower with the 800 credit score, right? But when you get that borrower says, I want to buy a 3-unit property, I want to buy a 4-unit property, but I only have 5% down. Can you help me out? Right. So uh, we are going to provide you some interesting options today. But we also have some other options for like your renovation borrowers that want to purchase that property that may have condition issues where normally we would tell them, no, I'm sorry, that's not possible. Well, we have a lot of solutions here for everybody. So let me go ahead and pull up my quotes here a second. And all right. So my first option here that I'm sharing with you, excuse me, is for a salaried borrower that you can close a loan using only W-2, the most current year's W-2, and 30 days worth of pay stubs. Now, this would be also possible with 3% down if they were a first-time home buyer. So my example here, I'm assuming our borrower is not a first-time home buyer, so he has to come in with at least 5% down. But you will know that you have 7.25 as the lowest cost option, and you can buy it down to 6.125, and you can probably buy it down lower than that if your borrower is like this borrower that I have with a very high credit score. You will get your 2% bona fides, so you could probably buy this down into the high fives, maybe 5.75, 5.625 if your borrower is willing to pay like 3 points and still be able to close within compliance. The benefit here is that when you do run automated underwriting, depending on the strength of the borrower and the deal, will either ask you for 2 years W-2s or tax returns or not. In this case, for this hypothetical borrower, it would be a great situation because in reviewing their tax returns, I saw some unreimbursed business expenses that if we were to have to provide the complete tax returns to underwriting, they would deduct those unreimbursed business expenses from the overall income, and we would have a lower net income. And what I mean by unreimbursed business expenses, we get borrowers that even though they may be on salary or hourly, they decide to write off certain expenses that would be related to their job that their employer is not reimbursing them for. And if an underwriter reviews those tax returns, they will deduct that from their income. So very good situation here when we have a W-2 only finding. Now, that is usually the majority of the cases get this, but this would not be possible if we did not have automated underwriting to streamline the whole underwriting process. Now, similar to our salaried borrower that gets W-2 only, We also have the option. This is a very popular one. This is the one that makes or breaks a lot of deals. Our self employed borrower, where automated underwriting only requests 1 year's worth of tax returns. So we would have to provide the most recent year's tax return that was filed. Keep in mind, if you have an extension for the most recent year, you would provide the proof of the extension and the prior years to that to meet the 1 year option. This is amazing. During post pandemic, this saved a lot of deals because 2020, a lot of businesses really had reduced income. 2021, they bounced back. And if we would not receive the 1 year findings in our automated underwriting results, then we would have to average out both years and obviously have a lower figure. Whereas if we get the 1 year finding, we only have to use the current year. Best thing about these two options, as you can note here, is there is not a loan level price adjustment for W-2 only or 1 year's tax return. It is not something, unlike the non-QM world, it is not something that you can go and click a button and say, I want the W-2 only option or I want the 1 year only option. That's in the non-QM world. You can get that. Here in the automated underwriting world, it's basically luck of the draw.
You
But
have to ask for permission, basically.
yeah, yeah. They have to review the merits of the file, and you're basically the they is the algorithm, of the system will review the strengths and weaknesses of the file, and if they deem that the file is low risk, then it will ask for less items. If they deem that the file is higher risk, like lower credit score, issues with the credit, limited employment history, limited credit depth, those are just some of the features that could trigger more scrutiny. And more scrutiny means more detailed documentation to be provided, with the ultimate having to provide 2 years worth of tax returns for your salaried or self employed borrower. But like I was stating, there is not a loan level price adjustment for this. If you get it, amazing. So now, another little bit of a mind blower here, our home style renovation loan, right? Which is possible with as little as 5% down. Now, this loan is similar to the FHA 203K loan. Maybe most of our audience has probably heard about the FHA 203K loan more than they would have heard about Fannie Mae's home style renovation loan. But this is basically the conventional Fannie Mae version of that renovation loan, which allows for the purchase or refinance. Also, mind you, this is also a refinance option, but it allows for, in this example, for the purchase of a property that either A, may have condition issues, which does not allow it to close with a regular conventional loan, or simply maybe a borrower that is buying a dated property and would like to remodel it and not want to incur having to use their credit cards or separate unsecured loans from offered by vendors at 14%, 18% rate, whatever they may be. And which also, those loans are not tax deductible. The interest on those loans is not tax deductible. Um, they can use a home style renovation loan to purchase the property and include a certain amount of monies for the remodeling. Maybe they want to have a new kitchen and they haven't been able to find the house their dream house, but they found one in a great location. Well, this program allows you to make that house your dream house if you like where it is, and that way you can have the kitchen the way you like it. You can have the bathrooms the way you like them, maybe the flooring, whatever it may be that you want to renovate in the home. Obviously, there is a limit, but dollar amount, this is not a ground up construction loan either, but it will allow you to solve a lot of the issues. Now, one of the big issues is, let's say you're buying a foreclosed property that's missing components, and you would not be able to close that with a regular conventional loan if it's missing kitchen cabinets, or if the bathroom is basically destroyed, the toilet's missing, the vanity's missing, the shower is half done, the air conditioning unit outside and inside unit, for those of you in the country that have air conditioning, is missing, or maybe the heater, is missing, and they tell you in regular financing you cannot close. You're missing those components. Your house is not 100% complete. We're not going to allow you to escrow any money for repairs for any of those items. So normal financing, you would be stuck. With the renovation loan, you would get the deal and you would get your dream home. And as you notice here, the rates are not really that much higher than the regular rates. You have 7.625 costing you a little bit of money there, and your lowest cost option, and you can buy it down to 6.625 for a purchase that normally would not have been possible. So this is really a dream maker loan. And those of you should get a handle of this, because there's a lot of frustrated people out there looking for homes that this could provide a solution. Or conversely, you could do the refinance version of this product, and they may not have to move at all. They may be able to just do what they need to do to their current home and stay right there. So now another option, which is very interesting, is Fannie Mae's Home Ready, which is a first-time home buyer option. Now, this product does allow for as little as 3% down for a 1 unit. For the 2 to 4 unit, it allows as little as 5% down. So super interesting, because you can buy a 4-unit property as your first home, as a first-time home buyer, no investor experience needed, 5% down, reduced mortgage insurance as well. And look at these rates. 6.5% is your lowest cost option, and you can buy it all the way down to 5.75%. Amazing option. This option, like I mentioned, is also available for a 1-unit property with as little as 3% down. The only catch is that you have to be a first-time home buyer. And first-time home buyer is defined by Fannie Mae as a borrower that has not owned a property in the last 3 years. It doesn't mean that they've never owned a property in their lifetime, and they can't obviously qualify if they just sold their property. They have to not have owned a property in the last 3 years. So 4 very good options here. And these options, like I mentioned, are also available for refinancing. A little bit of a lower LTV, but they are all available for refinances. So look to Fannie Mae for stuff out of the ordinary cookie cutter type files, and you will increase your business.
Okay, great. I don't see any questions here on the topic, but definitely some different interesting spins there. If you want more info, you can visit us at themortgagecalculator.com. We can connect you with one of our 340 loan officers across the country. We are licensed in 24 states for Fannie Mae loans, like Jose just went over. Remember, we do this show every weekday at 11 a.m. Eastern, where we go through the different live rates of different programs and then do a deep dive into a different topic like we did every day. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see everybody tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody. Have a great day.